So if Warren Buffett was so successful with the investing methods as taught to him by Benjamin Graham, why did he completely change his approach after he met Charlie Munger? To answer that question, in this video, we're going to explore the details of both these investing methods because they're quite different, the pros and cons of each of them, exactly what the revelation was that made Buffett switch, and what that means for you and I as small retail investors. Mainly, which one should we be using? The classic Benjamin Graham approach, or should we be using a more Charlie Munger-like approach? After all, Warren Buffett himself even said that if he was working with a small sum of money, as in under $1 million, or even under $10 million, that he would be much more inclined to be looking amongst what you would call the more classic Benjamin Graham stocks. Let's just back it up for a second though, so I can put everything into context for you. Warren Buffett, as a young man, discovered this book right here, The Intelligent Investor by Benjamin Graham. And it was this discovery that put him down the path towards becoming the world's most famous investor. Now, in the year that I'm recording this, he's the 4th richest person in the world, but he's been amongst the top 5 richest people in the world year after year for decades now. Warren Buffett was not even 20 years old yet when he found this book, but he knew enough to realize that he had found something very special. He read it and he reread it. Benjamin Graham became like a god to him. And when he realized Benjamin Graham was teaching a value investing course at Columbia Business School, right after he had just been rejected by Harvard, he knew that he had found his path. Once he was enrolled and class was in session, Buffett was the youngest person in his class. He was also the most knowledgeable. And eventually, after the program was over, Buffett convinced his teacher, Benjamin Graham, to give him a job at Ben's investment firm. To make a long story short, Buffett eventually went on to start his own investment partnership, continuing to use the Benjamin Graham teachings, and was able to achieve a compounded annual growth rate of 29.5% between the years of 1957 and 1969. Just look at this chart to put that into perspective for you. This compares the returns of the Dow Jones Industrial Average versus what Buffett achieved with his partnership, starting with $1,000 at the beginning of that period. And even before this time period, he was averaging roughly 50% per year, starting around when he first met Benjamin Graham in 1950. But again, if Warren Buffett was so successful with the investing methods as taught to him by Benjamin Graham, why did he change after meeting Charlie Munger? One of Buffett's more famous quotes is that it's better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price. And you might be surprised to learn that this quote is actually him comparing the Charlie Munger approach to the Benjamin Graham approach. See, Benjamin Graham, he was all about the fair business at wonderful prices. And when he says wonderful, he really means it. He called it a cigar butt stock. Essentially, the focus was on buying stocks for below their net asset value. Or in other words, stocks with extremely low price to book ratios. Warren Buffett is the most famous of the Benjamin Graham disciples, but there were a lot of investors that followed the Benjamin Graham approach and had amazing success. One of them being Walter Schloss. Walter Schloss never wavered from the Benjamin Graham approach, and in his investment career, he averaged a 15.3% compounding return over a 45-year period, which is amazing. Over that same period, the S&P 500 did 10%. Warren Buffett and Walter Schloss were friends, by the way. They worked together at Benjamin Graham's investment firm back in the early 1950s. One of Walter Schloss's golden rules of investing was to buy assets at a discount rather than to buy earnings. He said earnings can change dramatically in a short time. Usually, assets change slowly. And he goes on to say that one has to know a lot more about a company if one buys earnings. Here's what Buffett had to say about Walter Schloss, by the way. He said, Walter knows how to identify securities that sell at considerably less than their value to a private owner. And that's all he does. He owns many more stocks than I do and is far less interested in the underlying nature of the business. I don't seem to have much influence on Walter. That is one of his strengths. No one has much influence on him. Let me reiterate because this is important. Back in those days, these guys were able to purchase stocks for less than they could be liquidated for. As in, let's say the price per share for a stock was $2. And meanwhile, that company had $4 per share of cash and 0 debt. In this example, you would be paying $2 for a share that had the intrinsic value of at least a minimum of $4. Doing this is what they refer to as buying a dollar for 50 cents. For those of you watching this that didn't realize that this was actually a thing until right now, yeah, through the stock market, you can actually buy shares of stock for less than its liquidation value. Yes, this is seriously a real thing. And if you had enough money to buy enough shares in one of these companies to have a controlling interest, you could even force the management to pay out all that excess cash to its shareholders, including yourself, as a dividend, for example, to unlock that value for you. Buffett did something very close to this when he bought Berkshire Hathaway. Berkshire Hathaway was actually originally a textile manufacturer. According to Alice Schroeder's book, The Snowball, Buffett was initially attracted to Berkshire because it had $19 of book value per share, but was priced at and trading for just $7.50 per share. Okay. I could probably make a full video on this little history lesson here, and if you'd like that, let me know in the comments. But I want to get back to the point of this video. The Benjamin Graham way versus the Charlie Munger way, and what is best for you. By now, I'm hoping that you understand the basics of the Benjamin Graham way. Buy cheap assets. Super cheap. Now I want to explain the Charlie Munger way and the revelation that Warren Buffett had that made him change his investing approach to this way. So here it is. Unlike Benjamin Graham and Walter Schloss, who really didn't care what kind of business they were buying, to Ben Graham, every business had a price at which it was enough of a bargain to start buying. Charlie Munger, on the other hand, he realized that there were some businesses out there that had incredible economics working in their favor, competitive advantages that made them almost like a monopoly. Charlie Munger and Warren Buffett together, they realized that if a company had a durable competitive advantage, which they sometimes refer to as an economic moat, then there's really almost no reason to ever sell your stock. Year after year, these types of businesses will continue to grow in intrinsic value at a compounding rate. The longer you hold on, the more you get to profit from the great economics of the business, as well as tap into the powerful effect of compounding. In contrast, Benjamin Graham, he would sell a stock if it had gone up by 50%, or even if it simply just hadn't moved after 2 years. Ben Graham really could not care less about where the business would be in 10, 20, or 30 years down the road. Another thing that the Charlie Munger approach has going for it is that by just not selling for 30 or 40 years, it means you only have to pay taxes once. And according to Charlie, this savings in taxes by not jumping in and out by just holding ends up being the equivalent to about 1 to 3 extra percentage points of profit per year. 1 to 3% per year might sound insignificant, but over a 30 or 40 year period, this equates to a ridiculous amount of extra money in your pocket. $10,000 after 40 years compounding at 10% turns into $452,000, whereas $10,000 after 40 years compounding at 13% turns into $1.3 million. Big difference for just 3% per year. The other thing that made investing in companies with durable competitive advantages so great is that they no longer had to wait until the stock market gave them a wonderfully low price before they could buy in. They could buy these types of businesses at even just a fair price and still turn out a very fine result, as long as they held them for long enough. So all of this does sound pretty awesome, but what does it mean for me and you? Remember what Walter Schloss said? He said it's easier to buy assets at a discount than it is to buy earnings. Here, he's basically saying, my way is easier than Charlie's way. Remember, his reasoning is that earnings can change dramatically in a short time, where usually assets change slowly. His opinion was that one has to know much more about a company to buy its future earnings. And that makes sense. It would be hard to argue against that. If you are going to go the Charlie Munger way, you are going to need to do your research, and probably more research needed than if you're going to go the Benjamin Graham way. For me personally, I prefer the Charlie Munger way, and one of my main reasons for that is that if you're using the Benjamin Graham way, you're required to sell your stock once it's risen to its intrinsic value. Holding a company for 10, 20, or 30 years just isn't a thing with that approach. And I don't know, I just don't want to have to worry about selling. The Ben Graham way is much more of an active approach to investing that really doesn't appeal to me. There's something else that caused Warren Buffett to move away from the Ben Graham approach to the Charlie Munger way, which is that over time, as they built up more and more money, the Benjamin Graham approach really wasn't feasible or even possible for them with such large amounts of capital. And also, these types of stocks became more and more rare than they were back in 1950s and 1960s. You can still find these types of stocks, but you're not going to really find them in North America. You might have to go look in Japan or Korea, something like that. However, with that said, the Benjamin Graham method is still accessible to today's investor. You're just going to have to look a lot harder than they did back in the 1950s and 1960s. Now, here's a quick clip of Charlie Munger talking about this subject that I want you to see before I give you my final thoughts.
Well, I agree that all intelligent investing is value investing. You have to acquire more than you really pay for, and that's a value judgment. But you can look for more than you're paying for in a lot of different ways. You can use filters to sift the investment universe, and if you stick with stocks that can't possibly be wonderful to just put away in your safe deposit box for 40 years, but are underpriced, then you have to keep moving around all the time. As they get closer to what you think the real value is, you have to sell them and then find others. And so it's an active kind of investing. The investing where you find a few great companies and just sit on your ass because you've correctly predicted the future, that is what it's very nice to be good at.
Okay, so now I'm hoping that you have a very clear idea on the two types of investing methods available to you, which just boils down to buying cheap assets versus buying future earnings. Of course, you could create some sort of hybrid approach, but generally speaking, these are the two approaches you can take. If you're like me and you choose the Charlie Munger approach, then the next step that I would suggest for you is to learn about how to calculate the intrinsic value of a business so that you can make sure that you're paying a good price for your stocks, or at least a fair price for your stocks when you buy. So that's the video of mine that I'd suggest you watch next. In this video, I cover how to calculate the intrinsic value of a business in a very practical way that you could follow along with using the different stocks that you've found. And I also explain the IRR formula, which is incredibly useful and is something that you must know. It's almost like a reverse calculation that calculates for expected annual returns. Super cool and very important. And finally, I include a number of clips of Warren Buffett and Charlie Munger talking about how they calculate intrinsic value, and these are clips that I've hand selected to include in this video to help lock in the lesson. So definitely check out this one right now if you want to continue on your journey to becoming a master stock investor. Please remember that I'm not a financial advisor. I'm just someone who loves stock investing and has spent years learning about stock investing. Do your own due diligence and your own critical thinking and make your own decisions before you take any action on anything that I put out there anywhere. And I'll see you in this next video right here.